You'd assume a crypto exchange makes money the same way its users do, by betting that prices go up. That seems logical. Exchanges are, after all, sitting right in the middle of the crypto market, watching Bitcoin and Ethereum swing wildly every day. But the reality is that most exchanges don't actually need prices to rise at all. They make money whether the market crashes or soars, as long as people keep clicking buy and sell. Understanding why reveals something most users never think about. The safest looking part of crypto, the platform you trust to hold your money, is often built on a foundation far shakier than a bank. Start with what an exchange actually sells. It isn't Bitcoin. It isn't Ethereum. It's the transaction itself. Every time someone buys or sells crypto on a platform, the exchange takes a small cut, usually somewhere between a fraction of a percent and around 1% of the trade. On its own, that sounds tiny. But multiply that fee across millions of trades happening every single day, from casual users buying $50 of Bitcoin to institutions moving millions, and you get a business model that scales with activity, not with direction. A market crash that sends retail traders into a panic-selling frenzy can generate just as much fee revenue as a bull run that sends everyone rushing to buy. The exchange wins either way. Volatility, not growth, is often the real fuel. That distinction changes what an exchange is actually incentivized to do. If profit comes from volume, then an exchange's business goal isn't to help you make good long-term decisions. It's to keep you trading. This is why so many platforms push notifications about price swings, offer margin trading that lets users bet with borrowed money, and design apps that feel more like a game than a brokerage account. None of that is necessarily malicious. But it does mean the apparent product, a simple way to buy crypto, isn't really the source of the exchange's value. The actual source of value is your activity, repeated as often as possible. Now add the part that most users never think to question: where does your money actually go after you deposit it? On a traditional stock exchange, custody of your assets is heavily regulated, segregated, and audited, with clear rules preventing a brokerage from using your money for its own purposes. Crypto exchanges, especially in their earlier and less regulated years, didn't operate under nearly the same level of oversight. When you deposited funds onto many platforms, you weren't necessarily storing coins in a personal, segregated wallet. You were often trusting the exchange's own internal ledger, which said you owned a certain amount, a ledger the exchange itself controlled, with far less independent verification than a bank statement. That gap between what a ledger says and what actually exists in reserve is where the real risk of this entire industry lives. As long as customers aren't all trying to withdraw their funds at the same time, the gap can stay invisible for years. It's the same fragility that has caused bank runs throughout history, except crypto exchanges, particularly offshore ones, often carried none of the deposit insurance or capital requirements that make traditional banking runs rare and largely survivable. This is the counterintuitive discovery at the center of the whole system. An exchange can look enormously successful, with billions of dollars in reported user assets and glowing headlines, while quietly holding far less in actual reserves than customers believe. The clearest case study of this entire chain reaction is FTX, once one of the largest crypto exchanges in the world. Founded in 2019, FTX grew at an extraordinary pace, becoming a major sponsor in sports and entertainment, backed by prominent venture capital firms, and led by a founder who was frequently profiled as a genius reshaping finance. By its peak in 2021, FTX was reportedly valued at around $32 billion. Millions of users trusted the platform with their funds, drawn in by its polished branding and its apparent legitimacy within an industry still fighting to be taken seriously. The first warning sign came from reporting that revealed a close and unusual relationship between FTX and a separate trading firm, Alameda Research, also founded by the same person. The concern wasn't simply that the two companies were related. It was that Alameda's balance sheet appeared to rely heavily on FTX's own token, a currency the exchange had essentially created itself, as if a company had used its own stock as the primary collateral for its debts. When that report became public in late 2022, it triggered exactly the kind of event that fragile custody systems can't survive. Customers, suddenly nervous, began withdrawing their funds at scale. What followed was the domino effect this entire structure had been quietly vulnerable to for years. As withdrawal requests poured in, it became clear that FTX did not have enough in reserve to cover them. Reporting and subsequent investigations indicated that a significant portion of customer deposits, potentially in the range of $8 billion, had reportedly been used to fund Alameda's trading activities and cover its losses, money that was supposed to belong to individual users, not the exchange's own related business. Within about a week, FTX halted withdrawals, filed for bankruptcy, and its founder was later convicted on multiple counts of fraud. A company valued at $32 billion months earlier became, functionally, worthless almost overnight. That collapse forced the entire industry to adapt in ways that are still unfolding. Major exchanges began publishing proof of reserves reports, cryptographic attestations meant to show that customer assets are actually held one-to-one rather than commingled with company funds. Regulators in multiple countries accelerated efforts to bring exchanges under rules closer to those governing traditional financial custodians. None of these changes eliminate the underlying tension, but they represent an industry admitting, under pressure, that the trust it had been asking for was resting on far less verification than it implied. So what does owning or operating a crypto exchange actually look like, best case versus worst case? In the best case, an exchange generates enormous, steady fee revenues simply by facilitating activity, maintains genuine one-to-one reserves, and becomes one of the most consistently profitable business models in finance, largely insulated from whether crypto prices rise or fall. In the worst case, the fee-driven incentive to maximize volume, combined with weak custody practices and minimal independent oversight, creates a structure where customer trust is quietly substituted for actual reserves, a gap that stays invisible until the exact moment it becomes catastrophic. Underneath the trading charts and the price alerts, a crypto exchange was never really in the business of crypto. It's in the business of trust, sold at scale, one transaction fee at a time. That trust is either backed by something real, verifiable, and boring, or it's backed by nothing more than a ledger nobody has independently checked. The exchanges that survive long-term are the ones that treat that distinction as the entire business. The ones that don't eventually discover that no amount of user growth, brand recognition, or celebrity sponsorship can substitute for money that was actually there the whole time.